Welcome everybody to today's webinar, Regulation A+, Practical Tips and Guidance for Launching a Mini-IPO. I'm Pamela Greene, a partner at the law firm of Mintz, Levin in the Securities and Capital Markets Practice Group. And I have here with me TJ Berdzik, Maggie Chou, Ryan Feit, Yoel Goldfeder, and Rudy Singh. Before we get started, we're going to have some housekeeping notes. The webinar will be recorded. The recording and slides will be sent to all participants after the webinar. If you are calling in through your computer, please be sure to turn up the computer's volume. Questions will be answered at the end of the presentation. Please use the Q&A application to submit a question. Now I'm going to turn it over to the panelists who can bring us a unique perspective on Reg A+. TJ?
Good afternoon, everyone. My name is TJ Berdzik. I'm from StockCross Financial Services. StockCross is a broker-dealer that actively makes markets in over 2,000 securities in the OTC marketplace, including development stage, financial companies, and preferred shares. We are listed in the OTC marketplace under the MPID STXG.
Hi, my name is Maggie. I work at OTC Markets Group in the Corporate Services Division. OTC Markets, we operate the marketplace for over 10,000 securities that are not traded on the NASDAQ and New York Stock Exchange. Of those, they range from 3,000 ADRs, international companies, to thousands of venture stage development and growing companies that have interesting stories to tell.
Hi, I'm Ryan Feit. I'm the CEO and co-founder of Seed Invest. Seed Invest is a leading equity crowdfunding platform. Over the past few years, we've been working with accredited investors and built up a network of 13,000 accredited investors and have invested in over 50 companies in the last couple of years. More recently, we have been taking advantage of the changes under Reg A and have helped 3 companies successfully test the waters in the last few months, each obtaining over $10 million of investment interest. And we'll be providing more data on those initial case studies in a minute.
Hi, my name is Yoel Goldfeder. I'm the CEO of Vstock Transfer. We're a registered transfer agent with the SEC, representing about 500 public and private companies, maintaining their stock records and the integrity of their markets.
Yeah, hi, my name is Rudy Singh, S2 Filings. We're a financial printer assisting public companies over the past 15 years with their SEC compliance needs. We also have a printer that does the printing of their prospectus and annual report.
Today's webinar is going to cover 6 topics. The first, we'll discuss the rule, as it's fondly called Reg A+. Then we'll be discussing the SEC filings and the approval process. The filing is called a Form 1A, and it always needs to be filed with the SEC, and the end of the process is called Becoming Qualified. Topic 3 is the offering process, where we're going to focus on Tier 2 offerings. Then we're going to discuss managing shareholders after the offering, stockholder liquidity, and lastly, we'll follow up with a discussion on where are we now in the process. Reg A+ went into effect on June 19, 2015 as an amendment to existing Regulation A. Congress mandated the new rule pursuant to Title IV of the Jobs Act, which was designed to make it easier for smaller businesses to raise capital. The original Regulation A has been in effect for many years, but has been little used by companies because offerings were capped at $5 million per year, and all offerings required an in-depth full state blue sky merit review. The new Regulation A+ is available for companies organized in and with their principal place of business in the U.S. and Canada, and it can only be used by private companies. Regulation A+ has 2 tiers for issuers to raise capital. The first tier, Tier 1, is for offerings of up to $20 million in a 12-month period. The second tier is for offerings of up to $50 million in a 12-month period. What are the differences between Tier 1 and Tier 2? A company can raise money of up to $50 million and use Tier 2. So the bottom limits are not, so there's only a limit at the top line. If it's less than 50, you have a choice of doing a Tier 1 or a Tier 2, but if you're above 20 million, you may only offer in a Tier 2 offering. The first difference is that in a Tier 1 offering, it is subject to state review as well as SEC review, whereas a Tier 2 offering, only SEC review is required. Although in a Tier 1 offering, there is still full state merit review as in the old Reg A+, the states are coming together and trying to make it more easy to qualify by a coordinated filing process. In a Tier 2 offering, you're only reviewed by the SEC, although companies do have to make offering notice, consent of service of process, and fees similar to private placements. Both the Tier 1 and the Tier 2 offering allow offerings to unlimited numbers of accredited investors. However, in a Tier 2 offering, the individual investment amount is limited. No unaccredited individual may invest more than 10% of their annual income or net worth, and for entities that are unaccredited, they may not invest more than 10% of their annual revenue or assets as of the most recent fiscal year end. Both Tier 1 and Tier 2 require 2 years of financials. However, in Tier 1, those financials may be unaudited, whereas in Tier 2, they're required to be audited. Tier 1 does not have any ongoing reporting required, while Tier 2 has a semi-annual, annual, and current report requirements to be filed with the SEC, making it more like a public company. Under both Tier 1 and Tier 2, affiliates are limited in selling shares in the Reg A+ offering. For Tier 1, they're limited to no more than $6 million in a 12-month period, inclusive of the $20 million total cap. For Tier 2, it's up to $15 million. In addition, all selling security holders in an offering, whether they be affiliates or others, are limited to selling no more than 30% of the total offering amount. And that amount is for the first Reg A offering and all subsequent Reg A offerings in the next 12-month period. What is the real benefit of a Tier 2 Reg A+ offering? One of the benefits is anyone may buy shares, accredited or non-accredited, and those shares are freely tradable in secondary sales. There's no limit to the number of unaccredited investors, and there's no requirement to verify financial status as there is in some forms of private placements for unaccredited investors. Companies may also conduct general solicitation prior to filing with the SEC. This is known as test the waters, and we'll be discussing this momentarily. Less SEC disclosure is required in the offering and for ongoing reporting, so it's less expensive to be a Reg A+ qualified company than it is to be a traditional traded public company. The SEC review is expected to be less intensive than in an IPO, and potentially there'll be a shorter time frame from start to completion of the deal. Lastly, issuers may go public after a successful Reg A+ offering later simply by filing a Form 8A with the SEC, which is a short-form 3-page registration under the Exchange Act. So it's an easy ramp-up and a cheap way to eventually become a public company. What is Test the Waters? Test the Waters permits companies to gauge the level of interest in a prospective offering before filing any materials with the SEC by communicating orally or in writing in any manner to determine whether or not there's an interest in the company. And this is the same whether it's a Tier 1 or a Tier 2 investment. The communications are considered by the SEC to be solicitations of interest only. No solicitation of money or other consideration, and there can be no commitment to invest. None of this is until at least the Form 1A is qualified by the SEC, and that comes at the end of the process, which we'll discuss in a few minutes. Lastly, and most importantly, all written communications or broadcast scripts must be filed with the SEC as exhibits to the offering statement. So the SEC will receive and see all of the testing of the waters materials later on in the filing process. The communications are subject to the anti-fraud provisions of the federal securities laws, so they must not be misleading or inaccurate. If solicitation of interest materials used after the public filing of the offering statement contain information that becomes inaccurate or inadequate in any material respect, the SEC will require revised solicitation of interest materials to be redistributed to participants and be redistributed in a substantially similar manner as the materials were originally distributed to the individuals. So it's important that any written test the waters materials be carefully vetted and make sure that at the time they're drafted, they're complete. The rule also requires certain information that must be conveyed in the test the waters solicitation. The information that the SEC requires differs if the solicitation occurs prior to or after the public offering of the filing of the offering with the statement with the SEC. The SEC, in recognizing social media, has approved the use of character-limited social media channels, such as Twitter, as a means of distributing the test the waters communications. Although these do not permit enough space to include statements required by the SEC has said that they can satisfy the requirements of the disclosure of the rule by including a hyperlink to a website that contains the required SEC statements for test the waters. The SEC filing and approval process for Tier 2. After the company has tested the waters, or while it's testing the waters, it files a Form 1A with the SEC. For a Tier 2 offering, that includes an offering statement, 2 years of audited financial statements and exhibits, including the testing the water materials. It's filed through the SEC's online system called EDGAR. The filing may be made confidentially through EDGAR for initial SEC review. However, all non-public submissions must be filed publicly at least 21 calendar days before the SEC qualifies the submission. The SEC will review the filing and send comments to the company, typically about 30 days after the original filing. The company, legal counsel, and the auditors will review and respond to the comments in writing to the SEC and file those through EDGAR. The company will also revise its initial documents based on the SEC comments and file the revised documents with the SEC through the EDGAR system. Once all comments have been cleared, the SEC will approve the filing by deeming it qualified. For an ongoing offering, qualification amendments must be filed to reflect any facts or events arising after the qualification date that represent a fundamental change in the information set forth in the offering statement. The offering has 3 parts. The first piece of the Form 1A is a notice to the SEC, which requires fill-in-the-blank information regarding certain basic information about the company and its proposed offering. It also helps to confirm the availability of the exception to the SEC. It requires issuer information, such as the issuer's identity, industry, number of employees, certain financial statement information, its capital structure, as well as contact information. It requires information regarding eligibility so the company can certify that it is appropriate to use Reg A+. There's bad actor certifications that requires certifications that officers, directors, greater than 20% stockholders, and others involved in the offering meet the no bad actor requirements of the SEC. It also contains summary information regarding the offering and other current or proposed offerings, the jurisdictions in which the securities are to be sold, and information on unregistered securities issued or sold within the past year. Part 2 is the offering circular, and it is similar to the IPO registration statement. However, the requirements have scaled disclosure. This is also where the financial statements are filed. It includes a cover page, table of comments, summary of the offering and risk factors, dilution from the offering, the plan of distribution and selling security holders in the Reg A+ offering, use of proceeds to the issuer, a description of the company's business and property, management discussion and analysis of financial condition and results of operations, otherwise known as MD&A, studying the 2-year financial statements, information regarding directors, executive officers, and significant employees, compensation of directors and officers, security ownership of management and certain security holders, interest of management and others in certain transactions, and information regarding the securities being offered. The last piece is the Part 3 exhibits, which are again similar to, but less required than an IPO registration statement. The exhibits required include the charter and bylaws of the company, the instruments defining the rights of the securities being offered, the subscription agreement, escrow agreement, material contracts of the company, legal opinion regarding the capitalization of the company, all of the testing of the waters materials that had been distributed to security holders, and the entire filing must be signed by the principal executive officer, principal financial officer, principal accounting officer, and a majority of the board of directors, which is like all public SEC filings. Now I'm going to turn it over to Rudy to talk a little bit about the EDGAR filing process.
Okay, so basically the EDGAR filing process is where the company would initially apply for codes. We will present to them a blank Form ID with instructions on how to fill that out, which will be returned to me at file@s2filings.com. Again, that's file@s2filings.com. We will process that. Upon receipt of codes and the document being drafted, we will in turn take that data and construct the XML filing. However, the miscellaneous documents, as in Part 3 mentioned by Pamela earlier, which are the exhibits, some of which may be in PDF format given the fact that they were previously signed. And if those documents are not available in Word format, we would basically ask for you to send that ahead of time, as it takes a while for us to extract that data and make it text searchable, which is one of the mandations, as we cannot file PDF documents with the SEC when it comes to these type of filings. We will go back and forth with regards to all the various amendments given the comments from the SEC, work with the attorneys along with the CPA firm, et cetera, and upon completion, submit each amendment accordingly based on the final approval of everyone. When the test filing is completed, we'll verify that there are no errors. We will go ahead and transmit the live filing, and a live filing receipt will be sent to the distribution group. Upon completion of the live filing, throughout the process until the final amendment in which they are deemed approved, we will then proceed to getting the offering at 100%. I would like to now turn it over to Yoel, who will talk about the offering process for Tier 2.
So I'm not going to go into the details of necessarily the offering process. We're going to talk about some of the mechanics. And it's always good when the SEC does some of the marketing on behalf of the transfer agent by mandating that some of the exemptions are only applicable if the company retains a registered stock transfer agent. As part of the process, the SEC always felt that it would provide added comfort and security to the investors. So in the initial process, when it comes to the closing of the offering, we typically do provide escrow services, meaning we would retain all the funds invested by the investors, and those would be held in a segregated escrow account until we've determined that the closing conditions, depending on the nature of the offering and how it's established, to make sure that all the closing conditions are met. And those funds are therefore not turned over to the issuer until the conditions met and everybody's ready to close. And then as the transfer agent, once the closing actually occurs, we would be in a position to then deliver the securities invested and purchased, be it in electronic form or in a certificate form, which is a nuance with Reg A due to the nature of the free trading ability of some of these securities. They may be eligible to deliver directly to brokerage accounts. So depending on the nature of the offering, we'd be in a position to deliver those securities simultaneously with the delivery of the funds to the issuer. You know, there's other processes involved, and I don't know if anybody's talking about obtaining a QSIT number, and there are many nuances when a company has free trading securities, which we'll get to shortly.
Thanks. So I'm going to talk a little bit about really what companies consider before they go through a Reg A plus offering. So Reg A plus have been talked about as mini IPOs. They really feel like what an IPO would do for a company, but at a structure that is hopefully much less costly and more efficient than what companies typically go through right now. So in a traditional IPO, most companies will engage an investment banker that does the underwriting. Here with Reg A plus, it's a little different, mostly because of this unaccredited piece, that a lot of these companies looking at Reg A plus offerings are those that might have a social media presence that can leverage Facebook, Twitter to kind of go after some of their customer base who would be likely investor base for them. And also, in general, really just changes with technology and the internet. You have a lot of funding portals that have popped up, and these funding portals they're different from Kickstarter or they're also not crowdfunding portals, as that rule has really not been sort of finalized by the SEC. But you have new intermediaries that are really trying to engage the investment community in ways that are different from the traditional IPO process of just institutional only. Pam talked a lot about testing the water, and you have a lot of websites that also have shown kind of popped up today that are helping companies really just market their deals. You can go, look at the deal that a company is trying to offer to the investment public. You can look at sort of history about them and just kind of click a button and say, hey, we are interested. Now, these are non-binding indication of interest, so there's no commitment to that. And then you have also kind of another piece where everything is a little more fragmented in a Reg A kind of offering, but you have interesting companies that are showing up that saying we can help you with the transfer agent piece, the escrow process. So these are all things that companies should consider. I don't think any of them are required with the exception of the transfer agent piece, or actually really at some point you need a broker-dealer, someone that is legally allowed to buy and sell a security, and I'll leave TJ to talk about that.
Thank you, Maggie. Broker-dealer registration is generally required for any person or entity that's in the business of executing transactions or soliciting the purchase or sale of a security. Under the Jobs Act, an exemption to the broker-dealer registration was created for funding portals. A funding portal is an intermediary in the offering or sale of securities, but is not permitted to offer investment advice, actively solicit investors, handle investor funds, or receive compensation based on the sale of securities. As a standalone entity, the funding portal is very limited in the services it can offer. Even displaying a certain listing as a deal of the day may potentially violate the prohibition on the offering of investment advice. In this evolving market, some funding portals have partnered with broker-dealers or have affiliated entities that are registered broker-dealers to allow the entity to offer more services. A funding portal that wants to offer prospective companies, among other things, advice as to the structure of the offering, valuation of the company, contacts among potential buyers, an affiliated broker-dealer will be needed. Maggie.
So what we see is, with Reg A plus, you can offer up to $50 million sort of in a 12-month period, and that's a pretty good size deal, at least, from what we see today kind of in the IPO market. And what's interesting with Reg A plus, we kind of expect to see a hybrid model where the companies might use some of the online portals to engage the retail investors and then work with a investment bank as a placement agent to get some institutional interest in it. So, in a deal that's $30 million, we can see very much a $20 million maybe coming. If there's indication of interest for $20 million, the last 10 would, be supported by institutions, and working with an investment banker will help with that. We'll talk a little bit down the line about liquidity, and what companies have to consider going forward is also if they want to have these shares traded, because these are freely tradable right after the offering, is who will be trading these shares. So again, traditionally, an investment bank would handle kind of the nuts and bolts, not just in the offering process, but also in the after and the secondary market. With Reg A Plus, we're going to see a little bit of a different model and structure, maybe companies only working with specifically a broker-dealer to buy and sell their stock after the deal has been done, or maybe someone that, we'll just see how the market goes from there.
Well, we're going to be talking about liquidity shortly, but this is Yoel, and let me talk about the maintenance and actually dealing with your shareholders. Because like many people going through an IPO process, this is the first time that you may be dealing with public shareholders or more shareholders than just family and friends, and dealing with them and corresponding with them is a whole new role that these companies would have to take on. So every transfer agent is registered and should be registered with the Securities and Exchange Commission. The whole point of our process is to provide comfort to the security holders. We act as kind of to make sure that the rights of the security holders in those securities and in their investment are maintained as well. So we act as kind of a go-between the company and the security holders. And then subsequently, once you are a shareholder, the process of transferring those shares, be it to a family member or a friend or even to your brokerage account, is something that we would help to facilitate. But as a precursor, when we're going public, when you're going through a public market, there's many steps that companies often are not familiar with. It's one thing to get a ticker symbol and to be traded, but to actually facilitate the electronic trading of those securities requires other work that needs to be done. There's an institution called DTC that maintains and manages the records of all electronic transactions. A company, in addition to getting a symbol being qualified for trading, needs to be qualified if they want to have their securities available to trade electronically. And that's something we often provide, a service we often provide to companies who figure that now that I have my symbol, why can't I just put all this stock into a brokerage account? And there's just other processes that are involved. You actually have to apply to DTC, and DTC has discretion for approval or not. And we've been very successful. Don't see that often that it's not approved, but it's just another process that has to go through. So while you're looking for a transfer agent, it's important to look for a transfer agent that's also what's referred to as fast eligible. Not all transfer agents, even if they are registered with the SEC, are eligible to provide electronic services through the DTC systems. We are, and it's important to find a transfer agent that is a fast agent. And in addition, there's ongoing requirements with the OTC that have recently cropped up requiring disclosure of capital structure and other information, which the transfer agent is often involved with, interfacing with the OTC, with FINRA, and with broker-dealers in connection with certifying the shareholder list and the data that is available with respect to the company.
Okay.
Yeah, SEC Rule 15C211 governs the submission and publication for broker-dealers of electronic quotations in non-NASDAQ OTC securities. Broker-dealers are required to review and maintain specific information about the issuer of a security before publishing a quote. Broker-dealers are gatekeepers. A broker-dealer must have a reasonable basis to believe that the information is accurate and free from error. Following a Reg A Tier 2 offering, the issuer must identify a broker-dealer to make a market in the issuer's securities. A due diligence packet will need to be provided to a broker-dealer, including, among other things, most recent financials, names of officers and members of the board of directors, articles of incorporation, security ownership among large holders, insiders. In all practical purposes, a copy of the documents and exhibits filed in the Form 1A should meet most of the market maker's due diligence needs. Once FINRA has approved a Form 15C211, a security can be quoted electronically in the OTC marketplace. Following 30 days of continuous quotation, a security becomes piggyback eligible, which means that other market makers can also disseminate quotes in the security.
So what TJ just kind of went through is the process of how securities kind of get traded on the OTC markets. And one of, again, the biggest question that we get, I'm sure other people are getting, is there a market for these Reg A Plus securities, as they are not, they're not fully registered. Companies are not required to do Sarbanes-Oxley. They don't have quarterly reporting requirements, hence they're not eligible to be traded on New York Stock Exchange or NASDAQ. What is sort of interesting about OTC Markets is our structure, and we allow for companies to have variable reporting. We have those that are international reporting, SEC reporting, and now Reg A plus reporting. And the process that we have for all these companies actually fit in the model of a Reg A plus offering. So companies can access liquidity and sort of what we call non-traditional IPO, but really a float deal process. On the screen, you'll see, this is a chart from a study the SEC did a couple years ago talking about liquidity in small cap companies. And these are of exchange, so these are it's data coming from NASDAQ and New York Stock Exchange. And traditionally, anything really under $1 billion in market cap are mostly held by retail and individual investor. So Reg A Plus is kind of conducive to small cap companies because it allows for unaccredited investors to buy into the stock. It allows for companies that typically don't have access to institutions now to go out there and sort of market their deals, not to just to a select group of people that might be a client of an investment bank.
Once the security is finally trading over the counter, which factors determine the liquidity of the security? The shares outstanding and most specifically the size of the float are going to be among your primary determining factors. The float are the number of shares currently available for trading. The float is the total shares outstanding, less restricted stock, and closely held stock. For example, let's say your company has 100 million shares outstanding, 70 million are held by insiders, and another 20 million shares are restricted. Well, your float's only about 10 million shares. So on a day-to-day basis, only a portion of those 10 million shares will be trading, or can trade, not the full 100 million. Composition of your holders is another factor to consider. Different holders have different holding periods. Institutional investors are more likely to buy and hold than a small retail investor. A company with 50 holders is unlikely to trade as actively as a company with 1,000 holders. So one must consider the diversity of your shareholder base. In addition, insiders are unlikely to actively dispose of their securities on a day-to-day basis. Typically, they'll utilize public offerings and private placements to seek liquidity. There are about 10,000 securities that trade in the over-the-counter marketplace. Of these securities, some may trade a couple thousand times a day. Some securities with very small floats, tight ownership, may only trade once a month. Okay. How can a company provide market support for its common stock? Simply put, the more information available and the more eyes looking at a security, the closer it will trade the fair value. To this end, investors need timely financial disclosure, widespread dissemination, and transparency. Investors want to see recent financial statements. Under Tier 2 offerings, an investor is required to provide ongoing financial reports. Company presentations and conference calls can help investors understand your story. How is your company different? How do you see your company growing in the coming years? What are the opportunities you're focusing on? Why do you deserve a premium valuation to the marketplace? Are there qualitative factors that may point to higher growth or reduced risk than the quantitative measures are missing? In addition, consider making transcripts of these calls and presentations available to investors. This will help new investors to get up to speed in regarding your company.
So as TJ mentioned, companies really benefit from providing more information, and with Reg A Plus, and at least for Tier 2, companies are required to only have to provide semi-annual requirements. So we have two marketplaces that are structured for Reg A Plus, OTCQX, our best market, and OTCQB, which is our venture market. Companies that want to just follow the Reg A Tier 2 offering and do semi-annual report can qualify for OTCQB and not have to do anything more than their existing requirement. So that, saves a lot of cost and time for companies, not having to go through all of the filing process that a traditional sort of 34 Act filer would have to go through right now. But they have a public vehicle. They have a price history, they have a ticker symbol, so it allows them access to not only kind of track where the stock is going without, and also being able, a channel to communicate with their investors. So OTCQX is our top market for companies that maybe are a little closer, a little more seasoned, and would down the line, you know, in about 12 to 18 months, uplist to NASDAQ and your stock exchange. And for QX, we require that companies actually provide quarterly financial statements. So the same information they have to do on a semi-annual basis, but provide it in a Form 1U with EDGAR. So 1U, I believe, is similar to an 8K in the Reg A plus world. So what's great about really our OTCQX rules is that it is structured to really make the shares on a Reg A, I guess, the most transferable and the most liquid. You know, investors expect to see quarterly financial statements, even though you're not required to do so. Also, for purposes of resale for affiliates, they'll need information that's considered to be current public information, so that will be quarterly financial statements. So, you know, companies have a choice between, you know, how much they want to provide and also what marketplace they can qualify for. And then, you know, we'll provide all the tools for companies to at least be as transparent as possible as they go through the process.
So we just wanted to talk a little bit more about liquidity, and one question that we got was the difference between Tier 1 and Tier 2, because someone had said that I understand that both Tier 1 and Tier 2 securities are freely tradable. And although that is a true statement, the question then becomes, how can you trade them? Because under the SEC and FINRA rules, the only way to trade on an established stock exchange like the OTC is if certain information is actually out there in the public market. In a Tier 1 security, which we'll talk about a little bit more, there is no requirement to have continued public information into the market. So thus, those securities are ineligible to be sold on the OTC market, and there would have to be some other type of market that would become available to sell those shares, and with limited information, it's much harder to be able to do that. Plus, as Yoel was talking about, most shares now are traded electronically, and DTC will not allow the shares to be traded electronically without their permission, and that's highly unlikely to be given to a securities of a company in which there's no public information that's out there and readily available. The last point I wanted to bring about is, what about the affiliates and the people that bought the shares in private offerings before the Reg A Plus deal? So as with a public company, shares that have been issued privately are still required to comply with Rule 144 to sell on a secondary sale. The same way as if you did an IPO, people that bought before the public offering still have to comply with Rule 144. There's two sets of rules. There's the non-affiliate rule and the affiliate rule. The non-affiliate rule, in this case for Reg A Plus, because the shares are not IPO traded, the shares have to have been held by the individual or in a chain of non-affiliates for 1 year prior to sale, and there has to be current public information about the company available. For affiliates, it's the same Rule 144 requirements as there are for public companies. There's the current public information as well as volume limitation, broker sales, as well as a Regulation A Plus requirement limiting the amount of securities sold during the first 12 months after the offering is qualified with the SEC. As Maggie has stated, the SEC has basically said that although for Reg A Plus deal, companies only have to provide annual disclosure, semi-annual disclosure, and current disclosure for certain matters, the SEC does not deem that information to be current public information with respect to the quarters when information isn't filed on a timely basis. So if a company really does want to trade onto OTC and be able to have its private investors that invested before the Reg A Plus deal, plus its affiliates be able to trade more seamlessly and only be subject to traditional 10b5-1 blackouts, they will instead have to file on a quarterly basis. If they choose instead to file on a semi-annual basis, as Maggie pointed out, there is a tier of the OTCB that they will be able to trade on, but the non-affiliates and the affiliates most likely will be able to trade during a less period of time than if they were a regular public company.
Okay, so I'm basically going to provide some information on what we've seen thus far with Reg A. Now, we don't have any data as an industry on investments yet. Qualification takes a few months, and as an industry, we're not there yet. But what we do have is some data on companies that have gone ahead and tested the waters already. So the first example here is a company called Waybetter, who used Seed Invest to basically reach out to their 270,000 investors shortly after Reg A kicked in, and their response was really interesting. They basically were able to obtain over $9 million of investment interest in just 48 hours from over 3,000 of their customers. And, you know, they basically proved out our thesis that customers would have interest in potentially owning a small piece of the company. At Seed Invest, we've helped a few companies, probably a dozen or so, take advantage of 506C to generally solicit and invite their customers to invest. But under 506C, only about 2% of the country is actually accredited and can actually invest. So, although we've seen some interesting data, the first case study under Reg A testing the waters really, I think, exemplify the true power of equity crowdfunding and the potential that Reg A has. So moving forward, Waybetter was sort of the first company to test the waters on our platform, and we've sort of proved out over the last couple months that it wasn't just a blip. We've now had 3 companies go out and reach out to their customer bases and invite them to potentially to express interest in potentially investing in the companies once they get qualified. All of these companies are consumer-facing companies that already had built established customer bases that were passionate about what they were doing, and went ahead and used testing the waters to reach out to their customers to determine how much interest there was prior to deciding whether or not pursuing a Reg A offering was a better option than a typical Reg D offering. In all cases, so Distilled, I believe, actually hit $10 million of investment interest last night. And between the 3 of them, there's just about $32 million of investment interest from 7,600 people. The mean investment amount, or indication of interest amount, I should say, was about $4,000 between the 3 of them. That's the mean. The median is right around $1,000 or towards the minimum, which I'll sort of provide more information on in a minute. And the really interesting thing for, I think, all of us in the industry, and obviously the companies included, to see will be these are non-binding indications of interest, so what will be the conversion rate of these indications of interest to actual checks? What we've seen on our platform over the last few years with Reg D, 506B and C, is that with the credit investors, we've seen about 60% roughly of people who have expressed interest actually ending up writing a check. That being said, there has been definitely a fair amount of offset of investors who had previously not expressed interest that under Reg D that have ended up investing. That has sort of offset most of that. With Reg A, I think we'll learn a lot in the next few months once these companies go out and invite the people who have expressed interest to actually invest. So moving to the next slide, one interesting finding we've seen from the data, here you can basically see across the 3 companies who have tested the waters thus far through Seed Invest, the indications of interest in aggregate over a period of 10 days. So what this basically shows is that, you know, the first 2 days are very key, and you really, as a company, that if you're testing the waters, you have 80% visibility really within just the first 48 hours. This, to me, really shows how powerful testing the waters is, because if you are a company that is weighing your options of a Reg A, which takes more time and is more costly than a Reg D offering with just accredited investors, it's an important tool to be able to reach out to your customer base, for one, to see how much interest there is prior to deciding to spend the money and the time to pursue qualification under Reg A. So the nice thing about testing the waters, again, is it doesn't cost anything, and it's very easy to do, and within a couple of days you can figure out whether or not it's a viable option for you as a company. Moving to the next slide, another piece of interesting data, you can see across the 3 companies that have tested the waters that about 75% of the actual indications have been from smaller investors, from those that are interested in investing, potentially investing $1,000. So this sort of, I think, helps illustrate the problem potentially with 506 B and C, where obviously you can raise a lot of capital from institutional investors and accredited investors, and Reg D is a better fit for a lot of companies and probably probably most companies, but you can see that there is a pent-up demand from smaller retail investors to potentially invest in pre-IPO companies. And you can see through this data that 506 certainly alienates probably the majority of would-be investors for an early-stage private company. And based on this data, you can see that non-accredited investors potentially are a viable pool of potential capital. The last piece I would make from this slide is that with typical 506D deals in the private markets, especially in venture, you're typically looking at a $25,000 minimum and potentially even a $100,000 minimum. And you can see from the data here that a $25,000 minimum, if you're trying to diversify and build up a basket of early-stage private companies, which you should if you're investing in this asset class, even for accredited investors, that might be too high of an individual investment minimum for the majority of accredited investors. So Reg A could be, even for accredited investors, a viable way to build a more diversified portfolio of early-stage companies. Just another cut of the data. So this probably shouldn't come as much of a surprise, just the law of large numbers. Across the 3 companies that have utilized our platform so far, you can see that large checks still make up a huge chunk of the aggregate investment volume. And this is not that dissimilar from what we see in 506B and C. We had an investor who actually invested $1 million into a company on our platform yesterday, and that obviously carries companies a long way versus investments of $25,000. Same thing you see with the IPO markets with institutional investors versus retail. That being said, based on this data, you can see that it actually is pretty evenly distributed. So although large investors like family offices and some accredited investors most likely will always continue to make up a big chunk of the overall investment volume, the volume from people that are looking to potentially invest $1,000, $5,000, $10,000 does actually lead to a decent amount of the overall aggregate investment interest that we've seen so far. So last thing for me is sort of just a comparison of what we've seen over the last few years with Reg D at Seed Invest versus the testing the waters data under Reg A, which I think helps to show the pretty broad disparity between Reg D and Reg A. So with Reg D, we've seen an average check size over the last few years from individuals of $40,000, investments as low as $5,000, largest investment being $1 million. Like I said, someone invested $1 million yesterday. The average number of participants for a 506D deal has been around 20. It can be less than that, and it can certainly be more. But if you contrast that to Reg A, what we're seeing, check size on average about 1/10 of what you see under Reg D, and I suspect it might actually kind of creep down a little bit over time. Smallest check being what we expect to be around $500. Of course, there's no mandated minimum or maximum necessarily under Reg A, but so far we've seen minimums of $500. Largest check, largest expression of interest thus far under testing the waters of $100,000. And with 2 of the deals, we've seen north of 2,000 people indicating interest in companies, and one of them north of 3,000, which is obviously incredibly different than 20 investors. So with that, I think I'm going to turn it over to Pam.
Yes. So the last thing we were going to discuss before a little bit of Q&A is what are the costs of the offering, because that is a question that I think we all get. And I think if you polled all of us in the room and probably everybody on the call, you would probably get a bunch of different answers. I think the one common theme is that we would all say that it definitely costs less than to do an IPO, and my guess is that it probably costs, about half. The SEC does not have any filing fees to file a Form 1A, whether it's a Tier 1 or a Tier 2. So there's no SEC fees, although there are state blue sky fees, which for a Tier 2 is, exactly the same right now as what it would be if you did a Reg D private placement. So again, it depends on how many states and whether, it's all the states. And as everybody is aware, there are different filing fees in states, and some states don't have any at all. So I think in the end, probably the blue sky and the SEC fees weigh itself, out. With respect to legal fees, there is drafting and there is due diligence involved, because at the beginning we spoke about how the anti-fraud rules still apply. The CEO, the CFO, as well as the board of directors actually signs the document, and it is filed with the SEC. And so, the company would behoove itself to make sure that they have legal counsel reviewing the document. In a typical IPO, you also have the underwriter. And if you don't have an underwriter here, then there is no underwriter's due diligence. And so that side of the equation in an IPO and the fees that you pay to the underwriter for doing the deal don't exist. So that would be reduced, as well as we believe the legal fees and just generally drafting one of these things would be reduced, because there is less information that is required to go into an offering document. And it's more like the cost of a private placement offering document than I would say a full-blown registration statement. The one thing to be careful of, though, is that there is a legal opinion required on capitalization. So if you're a company that only has 3 shareholders and you need a legal opinion of counsel, it's probably pretty cheap. If you've been doing a lot of private placements and you're switching counsel, it could actually be expensive and time-consuming to clean up that company's capitalization and to have a law firm actually give a capitalization opinion. I think similar with financial statements. So for Tier 2, they must be audited. You do not, you're not required to use a PCAOB auditing firm. So the auditor you choose may depend on your costs. And again, I think it depends, what stage your company's at, how complicated it is, and, how much, and whether you've been audited in the past, as to how costly and how much time it's going to take to do these audited financial statements. There could be placement agent fees if you're using a placement agent or you're using a site that actually charges a fee for the deal by the company. There's printer fees associated with the transaction, less paper, so less printer fees. And there would be transfer agent and related fees that would probably be similar to a public company, but again, some of that must be based on the number of stockholders, so that could be, reduced. And then there's miscellaneous filing fees. So I think all in all, we all agree that it's probably, we don't expect it to cost, the average IPO, I think these days is around $1 million of just legal fees. And I'd say that, confidently, I can say it's, less than half of that, but how low really depends on the company and how much work the company is doing on its own.
I want to kind of provide a little bit of just what we've seen at the macro level. So far, I think since June 19th, when the rules went into effect, 34 Tier 1 and Tier 2 filings have been publicly made. So that does not include any of the filings that are confidentially filed. So I know there's probably at least a dozen or so in the works. What's interesting about those, there's actually, it's a mix about 50-50 Tier 1 and Tier 2 deals, and they vary in size as small as 1 million to upwards of 50 million. So we see a lot of kind of diversity in the market, also in industry. Reg A Plus, I think there are certain industry, as Ryan mentioned, definitely those are consumer focused, that have a brand, that have, I think you can market something that you can buy off the shelf more readily. You can, a drug that has to go through, years of clinical trials. So we see a bit of that in what's being filed under Reg A Plus right now. There's a bank that actually has been qualified, and they're doing it for a transaction where it's an M&A transaction, and they're offering it so they can offer unrestricted shares to the investor of the bank they're buying. So that unrestricted piece is actually really important, because there are definitely limitations in who can buy into a deal. There are funds out there, pension funds, family offices that are not limited in buying into a private placement because they're accredited investors, but they're limited in the amount that they can invest. So under Reg A Plus, that wouldn't be an issue. So really looking at Reg A Plus as sort of another tool in the toolbox, somewhere that it fills in the gap between private placements and a big IPO that, is definitely much more costly, at least my own opinion, but not just in terms of monetary cost, but also timing. It takes, it could be 2 years for an IPO to take off and all the information, that's a lot of back and forth legal work, and, the SEC has said that they're trying to work through the Reg A Plus process in as timely manner as possible and not to create all of the hurdles that companies typically have to go through if they were to go through an IPO.
Okay, I'm going to turn it over to some questions, and I'm going to read the question and then, provide some of the answers, and then turn it over to some of the other participants to also provide answers on where they, on their expertise. The first question is, if one does a Tier 2 offering, do they become a Section 12 reporting company? Apparently, there's a separate regime so that neither a Section 12 or 15D company, and they can file a Form 10 or a Form 8A. So with that, I'm going to turn it over to Yoel, who I think commented on this a little bit at the beginning, where the SEC has actually given a break to companies that would otherwise be Exchange Act reporting companies.
Yeah, one of the big selling points of Reg A is that you are exempt from filing regular reportings. You have other reportings that are required for Reg A, but as long as you meet the exemption, such as retaining transfer agents, depending on the number of shareholders and things of that nature, then you're exempt from your reporting. And then once you are ready to step up and go on, I think you mentioned, Pam, once you're ready to go on to the next market, it's just filing of a short registration statement under the 34 Act, Form 8, if I'm not mistaken, to then move up if you want to become qualified for reporting, and then that obligates you to the full reporting regime.
Right. I mean, the other thing to point out is that as under the Exchange Act reporting regime, if you're a private company and you have 500 non-accredited investors, or you have a total of 2,000 record holders, then then typically you would have to actually go public by filing a Form 10 or a Form 8A. With respect to the Reg A Plus rules, the SEC has specifically said that if instead you engage a transfer agent who is Exchange Act qualified, you do not actually have to file the 8A, and you do not have to become subject to the Exchange Act. So the requirements, if you go over the 500 non-accredited or the 2,000 total, is that you have a registered transfer agent, and also the company must remain at a public float of less than 75 million, or if it has no float, have revenues of less than 50 million. So it does keep you out of the Reporting Act requirements a lot longer than if you just did, if you did a Reg D private placement and you sold to 600 non-accredited investors, you would have to become an Exchange Act reporting company, and there would be no way around it. So the SEC is showing through its regulations that it really does want Reg A to be successful, and does want to create this mid-tier between a private company and a company that's full-blown Exchange Act company. The next question is, have you seen a company from a foreign market do a Reg A Plus offering instead of offering on New York Stock Exchange or NASDAQ? The one issue I want to point out is if the company is incorporated outside of the United States, right now they are not allowed to use Reg A Plus. So a company would have to actually reincorporate and become the U.S. company. It would also have to have its principal place of business here in the U.S. So even if you were incorporated in the United States, if your CEO and your principal place of business was in Germany, for example, you would not be able to do a Reg A Plus offering.
Canadian issuers actually are qualified. So those that are on TSX Venture, or the Canadian Stock Exchange, they actually are considered to be eligible issuers for Reg A Plus offering. So technically, a company can be public reporting in Canada and not public reporting, as in they're not SEC registered in the U.S., and be eligible for the full benefit of Reg A Plus. Of the publicly filed Reg A Plus offerings, we have not seen any international companies, but it's definitely, just from our conversation with investment banks and Canadian issuers, and law firms, that they're definitely looking at this, since Canadian companies actually make up a good portion of private placements in the U.S. We see them kind of shifting a little bit towards Reg A Plus as well.
Yes, because Canadian companies are in the same position as U.S. And then, TJ, do you want to comment a little bit more about analyst or research reports generally?
Specifically?
Yeah, I mean, just as when, you know, will we see them? Do we see them? How we think that market will evolve?
Among very small companies. I mean, when you're looking at Reg A plus offerings, you're really looking more at micro cap, nano cap companies. There's always been a problem with research coverage among these companies, and the primary reason is you don't have for the third party providers, you really don't have the opportunity to profit off of this to generate revenue. That's why you see a lack of research coverage among that segments. I don't really see that changing much.
Yeah, and you look at just, again, going back to the breakdown of institution and kind of retail interest and small, I mean, I would say small cap, I mean, the data shows, you know, anything less than 500 million was by far, most of them was retail. There's just not a demand, you know, probably out there, and again, incentive for some investment banks to write research if, you know, their institutional clients are not in the deal.
Yeah, so two more specific questions that I think, you know, we covered. Just to reiterate, one of the questions was, so an issuer doesn't not have to prepare the Form 1A, only the solicitation materials in order to test the waters, and that is correct. And that is, I think, another reason why companies are attracted to these Reg A plus offerings, because you can create solicitation materials, you can go out there and you can solicit, and then you can decide that you're never actually going to do a Reg A plus offering, and in that case, you will never actually file anything with the SEC. It's only when you go down the path and want to continue on to qualification, before you're qualified, you have to make sure that all the materials are actually filed with the SEC. The second question was, in the first 48 hours, who is the test the waters marketed to, and is it just the customer base? And I'll leave that to Ryan to.
Yeah, so in all the cases, but it's been sort of the same, where we've had the companies go out and market to their customers first, so that would be the first 48 hours. And then we've, after that, marketed to the investor base on Seed Invest. So that includes about 13,000 accredited investors and then another 30,000 or so non-accredited investors who are on our platform. So overall, it's been a combination between the companies themselves and our investor base.
Another question we received was, what about registering a stock option plan like a typical public company? So because the offering is qualified and not registered with the SEC, the company cannot use the Form S-8 registration statement, which is the short form used by public companies. They can continue to offer securities to under their equity plans by using Rule 701, as long as they meet those requirements, and they can also privately place, as is often done with executive officers and directors, the shares. And then if the company does eventually become public, just like in a private to public company, they would be able to file an S-8 registration statement for options that have not yet been exercised, and people would be able to get freely traded shares subject to the same Rule 144 requirements as are currently in place for companies that go from private to public. Another question is there a limit to the number of investors that can invest per year under either Tier 1 or Tier 2? So we're all agreeing that the answer to that is 0. There's no limit on the number of investors. It's just dollar amounts, as we have seen, and then dollar amounts by unaccredited investors solely in Tier 2 offerings based on their own investment. Liquidity, if investors are quibs, do they also have 1 year before they're able to trade?
So when the SEC or Congress, in the rulemaking process, they actually said that quibs are by default any investor that buys into a Tier 2 Reg A plus deal. So there are no restrictions because the shares under Reg A plus Tier 2 are Reg A plus and are unrestricted. So I hope that answers that question.
Yeah. I think the next question, I think this might be a TJ. Are there any FINRA limits on broker-dealer compensation, cash, and warrants for acting as a placement agent or an underwriter?
They do. They're in standard. There are limitations, but they are generally rules of thumb. Traditionally with underwriting, I believe the rule of thumb was around 7%, but that wasn't exactly firm. It just can't be cost prohibitive. You can't charge a 50% fee for placing shares.
Right, and I think the offerings themselves do actually have to be reviewed by FINRA, and so the offering materials are sent to FINRA. So obviously, if there's an issue, you will be hearing directly from FINRA.
We have at Seed Invest, we have our own broker-dealer. We're regulated by FINRA, and we don't expect the sort of restrictions to be that much different than a normal IPO.
Great.
So they'll take all compensation, including warrants, into account.
Okay, great. The next question is, does the audit firm have to be PCAOB registered? Generally, it does not for a Tier 2. However, I think
we do require that if a company wants to trade on OTCQX, our top market, that the firm to be a PCAOB registered firm, which is a little different from audit prepared under PCAOB standards. So there's a difference between that, but the firm itself has to be PCAOB registered. And most firms are that you work with, so that's something you can pretty much check readily.
And this one I think is for Yoel. Do you expect Reg Plus offerings to use QSIPs? If not, how will they be identified?
Yeah, I expect that QSIPs will be used. Notwithstanding everybody's symbol, the way that securities are tracked usually and transferred from at least from an electronic standpoint is utilization of QSIP number. So that's still going to be a requirement.
So one of the questions, and I'll leave this to Ryan, can the offering be structured with a minimum and a maximum amount?
Yes, it can. So yeah, we fully expect offerings to have a minimum and then have a maximum.
Okay, and another question for you that I know you and I talked about beforehand is, what do you expect the conversion rate to be from expectation of interest of testing the waters to actual investment with your Reg A Plus clients?
Yeah, so again, with accredited investors, we've seen roughly about 60% of expressions of interest convert to actual investments, and then we've seen another sort of 30% of ultimate investments happen from people that didn't express interest, so there's been sort of an offsetting factor. With non-accredited investors, whatever I say will be wrong, so we'll know a lot more in 3 to 6 months.
Right, but I think we were talking that even in the general IPO context, if an IPO is successful and for an underwriter to say the deal's on a go, they basically say they've had to sell the book. Oversubscribe it like 2 to 3 times. So even in the IPO process, there generally has to be an expression of interest well in excess of the actual investors in the offering.
Right.
Yeah.
So I suspect what you will see is that with testing the waters, we've seen about 80% of the interest happen in the first 2 days. I think you'll see it a little bit more spread out over time. Whether it's Reg A or Reg D, everyone likes to be last money in. So I think it will be a little bit more dispersed in terms of people coming in at the last second as well.
Yeah. Another question is, how will income and our net capital be verified when soliciting non-accredited investors during Tier 2 capital raises?
Self-certification.
Right, self-certification. There is no requirement in the Reg A Plus as there is with the 506 C. So that is actually another attraction to the Reg A Plus for investors and actually for companies. We're just looking to see if there's any other questions, as some of them are a little bit duplicative. I think there's a question on Tier 1, can we adjust the price of our stock or offer discounts on stock after the price has already been assigned? So do you want to talk a little bit more just in your experience of the indication of interest and whether there's a price in those deals and how that?
Yeah, I mean, I think it varies, but, our expectation and what we've seen so far with companies that actually are undergoing the qualification process today is that they set a price per share when they file their Form 1A with the SEC. They have the right to adjust that over time prior to the offering, but I don't expect companies to adjust it once the offering's been launched, but I don't know if anybody else has any thoughts on that.
No, but there was some talk that, you can kind of structure a 1A offering in a way as a shelf registration as well. But I guess we'll have to, there's not a limitation, that's out there that's saying you can't do that. We haven't seen companies who go down that route.
Another question is, after a company has successfully raised funds under Tier 1, what would be the next logical place to go to raise capital? Can you then go and raise funds under Tier 2?
Yeah, I mean, the restriction, I believe, is up to $50 million in a given year. So I think it's pretty reasonable that you could see a company maybe raise, you could raise $10 million under Tier 1 and then raise another $10 million later through Tier 1 through the same investors or additional investors. And along the same lines, you could do a $20 million Tier 1 offering and then a $30 million Tier 2 offering that same year. So I do suspect that you'll see people go back to the well under Reg A, I think that's the question.
Right. No, I agree. And I mean, also, you don't have to, if you're raising $10 million, you have the choice up front whether you want that to be Tier 2 or Tier 1.
Sure.
You're not forced to go into the Tier 1 just because you're below the 20 million limit. The other thing is actually in the offering documents, when you're filing that first 1A with the SEC, you're allowed to do what's called a continuous offering. So it doesn't have to be a one-shot, we're closing all on a particular day. So you can say I'm filing for up to $50 million, and it can take you, 11 and a half months to raise the, to raise the money if you want to have continuous closing. The issue with that is obviously the expense, and then that you have to make sure that those offering materials remain up to date. And so it probably will, if there's fundamental changes in your business, you're going to have to keep making filings with the SEC. So for that reason, companies may decide we'll only leave it open for a month, we'll stop, and then we can launch, another offering.
Yeah, I think you also will run into the challenge of compelling people to actually make the investment versus just sort of dragging their feet and waiting for more information. So from our experience, it helps whether it's, Kickstarter or a platform to set a deadline so that people can make a decision.
And another question was, is it possible to obtain confidential treatment for a Reg A offering? And so how that works is the offering itself, if you've never done a Reg A Plus offering before, you are allowed to confidentially file it with the SEC. You can get comments back from the SEC, and you only have to publicly file everything 21 days before you want to be qualified. So basically 21 days before you want the money to come in. If the question is with respect to exhibit filings, the same rules apply to exhibit filings under Reg A Plus as they do under IPOs. If you're filing material contracts and you want confidential treatment requests with respect to some of those materials, you can do that, and you would go through the same process as you would in the IPO field.
I believe 2 of the Reg A offerings that's been qualified actually went through a confidential review. They were both filed and then almost exactly 21 days after qualified by the SEC.
Yeah, and I think you'll see a lot of companies do that. We have companies that are doing that now that, file privately and wait till you get comments back, and then you can always sort of make your Form 1A public later.
Right, and that has actually come from how it's been very helpful in the public markets. EGCs, the emerging growth companies, is how most companies have been going public, and under those rules, again, under the Jobs Act, the SEC allows companies to file privately, which in my experience, most companies take advantage of, go through at least one round of comments and clean everything up before they actually make their live filing with the SEC. And that's the reason why, with respect to the information that we have on Reg A Plus, none of us in the room really knows the full, amount of Reg A Plus offerings that potentially are out there, because we don't know what every law firm's drafting, and we don't know what is at the SEC that hasn't yet been publicly filed. Maggie, for you, just a quick clarification for someone. Can you review whether a Reg A Tier 1 and Tier 2 offering are listable on the OTC, or if it's only a Tier 2 offering?
So Tier 2 can qualify for both QB, OTCQB, and OTCQX. A company that's offering under Tier 1, they could trade on our open market, OTC Pink. We don't have any reporting requirements for companies on pink, but I can tell you, and maybe TJ can, that there are going to be certain just trading restrictions on companies that just don't provide information in the public. So, you know, a market maker can file 15C211 for a company that does a Tier 1 offering, but they're required to have adequate information, and sort of their willingness to do that is going to depend on how transparent a company is.
Someone asked a question if whether there are do liquidity constraints change after the first Reg A plus raise? I guess, once there's a Reg A plus, presumably you're going to have many more, shareholders in your company, and those shares can be freely tradable if possible. So it does seem that there's ability for everybody to get liquidity after you've done a Reg A plus deal. Obviously a lot easier in the Tier 2 context than in the Tier 1 context, as we've talked about. Another question is, can anyone go and see what has been publicly filed regarding the 34 companies? Is there a place on EDGAR?
It's sec.gov.
Yeah, so if you go to sec.gov, you can go into EDGAR. You can type in under form type, you can type in Form 1-A, and you will see the companies that pop up. And most of that though is only you can only see filings in the past, 4 or 5 days. I don't think if you can type into Form 1A and find the full list.
It tends to give you about 30 days.
30 days.
But nothing beyond that.
Yeah, and if you did know the name of a company and you thought they were doing an offering, you could actually type just the name of the company in, and it will pop up whether or not, they filed a Form 1A, the same way as if you were looking at a private company and wanted to see if they filed a Form D for a private company. Like if you look at some of the companies that Rudy mentioned, if you went online, you would see that they actually don't have the Form 1A, and that's because they're still in the phase of privately filing that with the SEC. So you can't, all you know is that they're not going to qualify and close within 21 days, but there's no way to know how close they are. Someone asked whether you'll be receiving email contacts from the presenters. The answer is yes. We will be, this whole slide presentation, as well as all of our information and our emails, will be attached and sent out to all of the presenters. So I think that is it for the questions. We'd like to thank everybody for attending and for the great questions that we received. Thank you.